Alright guys, welcome in. So today we're doing something a little different. I'm going to do this video going over my latest report which I published earlier this week. And I want to walk through the actual thinking behind it rather than just posting this report and leaving you guys to it. Because I think there is a lot to this one and there's a lot that we can work through properly. So the title of this report is basically, what happens if the Fed look through inflation? And I want to be really clear about what that means before we get into anything else. So looking through inflation doesn't mean that they're completely ignoring it. What it means is that the Fed sees it, they're acknowledging it, they understand it, but they're making a conscious decision that it doesn't warrant a policy response. That is a very, very specific choice, and it has ripple effects and consequences across every asset class. Now, I know some of you watching this are deep into macro. Some of you are newer to this stuff, and I'm going to try and pitch this so that both sides and both groups get something out of it. If I over-explain something you already know, just bear with me because I want everyone to be able to follow the logic chain from start to finish. Now, this whole topic about if the Fed look for inflation is so important right now. And the reason I've written it as a two-parter is because it really could be something that kind of manifests into markets. You've got inflation running above target. You've got energy prices driven around by geopolitics. You've got tariff pass-through working through. A lot of people forget that tariffs are still kind of moving beneath the surface. And yet the forward curve has begun to reprice in cuts. Not fully and definitely not to the level we see, but it is beginning to reprice in cuts. The market is basically betting the Fed is going to ease into this inflationary backdrop. The market is, pricing the reality that they will begin to look through inflation. I think the market is probably right, if I'm honest. I've laid it out in many reports where I kind of said I can't see the Fed holding rates or even hiking, which will crush labour and crush consumer spending, which both are not at levels to sustain this level of restrictiveness in policy. So the question I'm trying to answer right now is, what does this mean for rates, FX, and equity? So let's get into this. So I'll set the backdrop properly. Fed funds is sitting at 3.75%. Like I said earlier, inflation is still above target and it hasn't come back down cleanly. You've got energy prices being pushed around by Middle East dynamics, which honestly could go in any direction. And we've seen just how fast that can move. I think there is something that people are genuinely underestimating in terms of timing, which is if the Fed really put their foot on the gas and begin to cut through 2026, even as these tail risks persist. Now, these things obviously take months to fully show up in the data, especially core. And kind of the question on everyone's lips is, how is this energy shock going to feed into core? Because it really does begin to feed into things like food prices. So you look at all of that and think, okay, the Fed probably stays on hold for a while, maybe even leads towards tightening if things get worse, right? That would be the logical idea. But that is not at all what the forward curve is saying. The forward curve, which is basically the market's collective bet on where rates are going, is beginning to shift back towards pricing cuts this year. So if I head over to TradingView, this model is free and I've posted it a few times. If you haven't got access to this, just drop me a message, but it's completely free. At the extreme here, which was March the 23rd, we've begun to have 22.5 basis points, so just over one cut, fully priced into the December contract. Now, if you look at the forward curve from even 1 month prior, so if we just head back 1 month prior, go to the 23rd or 20th of February, we actually had the market pricing between 2 and 3 cuts around here. So we've not only just begun to price hikes, but we've also begun to price out all of these cuts. And this was at the extreme low. So when you look at, the drag on the S&P, I made it clear that I was quite shocked that the S&P was only around 9% down from all-time highs, considering we had the Iran war, tail risk, but not only that, we had massive repricing in the forward curve. And if we skip to now, the whole thesis I'm laying out is, what if the Fed are looking through inflation? You look at just how the forward curve, from this extreme low here, look at how the forward curve has begun to roll back over and actually begun to price cuts into this year. Now, we haven't fully priced in cuts. You look at the December contract, there's only 9 basis points of cuts priced in. But I'm not of the assumption that the aggressive unwind of cuts is going to be matched directly to the other side. But as we start to progress through data, as we begin to progress through either developments in this whole geopolitical tail risk, core CPI prints, PCE prints, we could begin to see this December 2026 meeting move more towards fully pricing a cut. Now, if I just head back over here, why would you cut rates when inflation is still above target and energy is pushing things higher? Why would they do that? And the answer is in the labour market and real consumer spending. So once you strip out inflation, real consumer spending is not at levels that can absorb rate hikes, right? It is okay that, I should say the levels of real consumer spending are okay. They are, let's say, they're not deteriorating massively, and they're also not causing this type of 2022 inflationary demand burst. It's really, really not doing that. And then when we look at the labour market, job gains have been softening. They really, really have. They've been softening. I believe there's a chart in a recent report just about the kind of 3 month, 6 month speed of the labour market. NFP headline, unemployment rate. We can definitely see softening there. But the whole thing is that the Fed is weighing up. Do we hike into an energy-driven price shock? So, it's not demand-driven. Very different things. And risk cracking the labour market. Or do we look through it and hope it fades? And I think this is kind of the core thesis of the report, that they're going to look through it. Now, they're going to call it a one-off supply side shock, which they've done very similar things when it came to tariffs. And the point of the fact is that in the long run, the inflation expectations are actually still anchored. So if you actually begin to look at kind of inflation expectations in 2027, 2028, you'll actually see these contracts are anchored. Now, this is the SOFR strip. This isn't inflation expectations, but you can see that there's been a lot of movement around these contracts kind of in the last week, in the last month, because inflation expectations around these contracts are actually anchored. Now, you can agree or disagree with the call that they'll eventually look for inflation or are looking for inflation. And I'd generally love to hear, what you guys think in the comments. But what I want to focus on today is not whether this is right, but what actually happens across markets if this path persists. Now, the implications are really significant, but they're also not obvious kind of on the first look, on first principles. So before we get into the whole rates picture, let me just kind of say a quick word on the forward curve and where I think there is interest in position right now. So the December 26 contract has a bunch of vol running through it. So I posted this here. So this is the 9th of December 2026. If you go onto the CME website, you'll actually be able to see the open interest on these contracts really clearly. And there's a huge amount of activity concentrated around that contract. And it's basically where the market is doing most of its debating about where the Fed is going to, what the Fed, I should say, is going to do with rates in the second half of the year. Now, if you're actually looking to trade the forward curve directly, so this curve directly, you have many options, which are here. You can just trade the March contract, the June contract, September or December. Now, as I laid out in this report, I kind of said, obviously the December contract's a bunch of running through it, as I just mentioned. But the most important thing I said is this: if you're trading the forward curve directly, which is this, rate expectations directly, you want to be most exposed to December 26 and March 27, in my view. Now, it was only last month that the terminal rate was hovering a lot later in the cycle. So we kind of moved from the terminal rate being around here, and we started moving down into contracts. And if, like I say, if you're looking to trade the forward curve directly, I would be focused heavily on Z6, which is December 26, and H7, which is March 2027. So my view here is, even if we get more repricing of the curve, and I think we probably will, the terminal rate, I probably think it doesn't move too much closer. I can't see us all of a sudden having the terminal rate in the H7 contract. I really can't, because that would be way too aggressive for the backdrop. I think even if, when I think about the logic of what the Fed is doing here, if they're going to cut into an inflationary backdrop, they're not going to do that kind of aggressively, because that would completely undermine their inflation credibility. And then you'll start seeing, the 10-year rates fly. And the terminal rate, in my view, stays roughly where it is now, even as the near-term path shifts around. So you may see shifts in, June, September contract. But if I'm honest, I think the terminal rate is anchored between Z7 and U7. So U7, September 2027, Z7, December 2027. Now, I think, once again, this is not me saying that if they're looking for inflation, they're going to do, 5 cuts. I don't think that at all. I think they're going to go slowly, 1 cut, maybe 2, spread them out over time. They're not going to rip cuts aggressively. Now, if we properly get into the rates picture, so still just kind of focusing on the SOFR strip, but if we're really getting into the rates picture right now, I'm starting to kind of think about, and every time I come to charts, is I'm trying to think about what is the 2-year doing and what is the 10-year doing, because I've said this a lot, and the most important framing principle there is this: you want to focus on rates first. So you want to focus on the 2-year, the 10-year, SOFR strip, Fed funds forward curve. You want to focus on those first. Then you want to focus on FX. Then you want to focus on equities. It's always in that order, because equities are downstream of everything else. They're a function of what rates and FX are doing. If you don't understand the rates picture, you'll go into misread equities and FX price action massively. Because, as I say, equities just reflect the current state of FX and rates, but rates are, the foundation. So we start here. So we start at the front end, the 2-year treasury. This is where Fed actually have direct influence, because the 2-year is closely tied to expectations for where the overnight rate is going over the next couple of years. And if the Fed is on hold and leaning towards maybe 1 cut, which is the scenario I think we're in this year, then the 2-year is basically trapped, because it's getting squeezed from both sides. On the upside, it can't really rally aggressively because the Fed isn't hiking and the market isn't pricing aggressive tightening. So it's kind of got that push and pull dynamic. On the downside, it can't sell off hard either, because you've got realized inflation running above target and liquidity in the system keeping a floor under things. So I do think we drift lower in the 2-year rates, but I don't think it's going to be a type of thing where we start melting down like with real speed lower than 3%. I think we will head there, but not with any type of aggression. So, think of it like this. Imagine the 2-year as a balloon being pressed from both sides. So from this side, both sides, it's like a balloon being pressed. It's not going anywhere, it's just getting squished. And in that environment, what drives the 2-year isn't directional repricing of policy, as we spoke about here. It's more so data surprises. So when you look at the 2 year, you want to know what is driving this most at a given point. So at a given point, it may be a CPI release that is, driving the 2 year rates. It may be an NFP print. It may be forward curve pricing. At any given time in the market, there is a specific data point that has most weighting to market movements. So I just wanted to make that clear. So every wages prints, every CPI print, every consumer confidence number becomes potential catalyst for a sharp short-term move, even if the broader direction doesn't change in the 2 year rates. So if you're running positions on the front end and you kind of have to respect that jump, you have to respect the X amount of data or specific data is now going to cause outsized move in rates. And I don't see 2 year rates breaking above the whole 4.1% ceiling in my view either, because the consumer backdrop and consumer spending and where the jobs market is, as I spoke about earlier, that would warrant a massively hawkish Fed, which I just can't see. But here's the thing that I think's underpriced about this situation, or should I say just underappreciated about this situation. And that is something I want to flag, though it's more important kind of in 2027 than it is right now. And that's the apparent calm in the front end, which is building pressure for later. Because what's happening is the Fed are holding rates lower than where a strict inflation mandate would point them. Liquidity is staying elevated in the system longer than it should. It's simple as that. And what begins to happen is you begin to see this reflected in the long end. Now, liquidity is staying elevated, right? And at some point, whether it's late 2026, 2027, 2028, it becomes unstable. And when it does, the Fed is going to be forced to hike. And they'll hike into whatever mess is waiting for them at that point, which could be a lot messier than what we're dealing with right now. So kind of file that away and think about this whole setup as kind of calm before the storm. Now, as I was just speaking about on the long end, the 10-year rates, this is where it gets interesting. I want to be really clear up front. The 10-year is not the Fed. As I said here, it's a complete different conversation. 10-year rates are not set by the Fed. They're set by growth expectations, inflation expectations, term premium, and increasingly by foreign bid for US assets and just cross-border flows. So here's the key question. When the Fed look for inflation, what does the bond market hear? Well, what a bond market is real rates are going to be held where a strict inflation fighting mandate would put them. The Fed explicitly or implicitly is choosing growth and labor market stability over price stability in the near term. And that will be evident if they do look for inflation. And the bond market has to reprice that decision. It has to price in actions of the Fed, where growth is likely to go, where inflation is likely to go. Now, there's two possible reactions from the bond market here. And scenario one is the market believes the Fed's call. It thinks inflation is genuinely transitory, and it will fade the Fed's credibility, and long rates will stay contained. So let me just repeat that. If the market thinks the inflation is genuinely transitory, it will fade, and the Fed's credibility will stay intact, and long rates will stay contained. So you're not going to see long rates bursting above this kind of 4.6% level. Now, scenario two, which I'm trying to map out and spend a lot more time thinking about, is that the market decides that the Fed is making a mistake, that holding rates lower than they should, kind of thing, and that inflation is still running hot and this is a policy error. And that is a scenario, and that's a scenario where term premium starts to rise. And this is where you get that counterintuitive and really kind of different scenario, because when the market starts to have one idea in the short term, Fed looking for inflation, and then saying, hang on a minute, this needs to be reflected in the long end because we don't believe that this is sustainable. And once again, as I say, this is where it gets counterintuitive and really important to understand, because if term premium rises, you can get a situation where the nominal 10-year yields here are going up, even as rate expectations are drifting lower, and we see the 2-year pressed down, because bondholders are demanding more compensation for the risk of holding long-dated paper in an environment where the inflation anchor looks shaky. So more duration risk starts getting hedged. And the long end, I mean, you could even say, the long end, so the 10-year bond, sells off even as the front end is anchored. So we're talking about bonds here, not the rates themselves. So that would mean the 10-year rate rallies as the 2-year either drops or, at best stays in a range. And that brings me to the big kind of trade and idea I spoke about here, which is the more interesting kind of thing is the 2-10 steepening. And the 2-year, so we say, it could be anchored by policy, and the 10-year drifting higher as term premium expands, which is a classic bear steepener setup. And I think is where the most interesting risk and opportunity lies, but I just don't think yet. At the minute, in my view, the best kind of reflection for this idea is inequities, which is why you've seen such a melt up in ES, with no pullback at all. And I did do a video on why exactly we're seeing such a melt up here with no pullback, and we're seeing kind of aggressive price action versus much more orderly that we typically see throughout the year. So if you go onto the Substack chat or go over to my Twitter, you'll see it's an 8-minute video that I've done a breakdown on this and all the tensions that were building under the surface at this low. So here's the thing about the 2s10s, and I want to be really direct about what bear steepening means for equities, because I think this is genuinely underappreciated right now. Most equity investors look at rate markets and think, the Fed might cut and it's good for stocks. And they're not wrong in straightforward rate cut environment. But bear steepening is a very different beast. It's not just the fact that rates are going up. It's the market basically signaling that it doesn't fully trust the Fed's inflation credibility. And that is a completely different transmission mechanism. In a bear steepening regime, so once again, if you go to capitalflowsresearch.com, you'll see this indicator there, which is just the 2s10s curve. You can change it to 10s 30s, but bear flattening here is represented in purple. And as I say, in a bear steepening regime, equity valuations get hit through two channels, and it's simultaneous. Rising discount rates and expanding risk premium. It's a double whammy. And the historical data backs this up. The S&P really struggles in these environments. Now, does that mean that I'm saying if we enter bear steepening, we're going to sell off? Not at all, because look at this. We've seen situations where there's bear steepening in a curve, yet ES just rallies aggressively. So not at all. And I'm not trying to use these binary and one-dimensional models, as I spoke about in the last video, where it says when one thing happens, the other must. No, there's a bunch of things you need to combine and ideas you need to put together to help you understand where rates, FX, and equities are heading. Now, I also spoke a little on the whole inflation swaps situation. So let's talk about that, because I think it's the most underrated indicator in the current environment, right? And it's one that most retail watchers just don't pay enough attention to, in my opinion anyway. So an inflation swap is basically just an agreement where one party pays a fixed rate and receives the actual inflation rate. So the price of an inflation swap tells you where the market thinks inflation is going to average over a given period of time. So it's a direct, clean read on inflation expectations without the noise of supply and demand for treasury bonds muddying the picture. So if you go over to TradingView, you can use this proxy. So if you just type in like T5YIE, you can use a proxy. This is the break even, but you can use it as a proxy for an inflation swap. Now, yes, they're two completely different things, but it's a very close proxy for anyone who hasn't got, access to inflation swaps data. I'd recommend just using the whole break evens charts. You can also get the 10-year T10YIE on TradingView, so that's the 10-year. So the part of the curve I care about most right now when it comes to inflation swaps is the whole 5 and 10-year inflation swaps. Now, this is the market's view on what's going to happen with inflation in the medium to long term. And once all this near-term noise is washed out, the market's looking and saying, okay, where are we sitting in kind of the 5 to 10-year range? And right now, those swaps are still broadly anchored near 2%. And it's pretty remarkable and kind of reassuring. And it means that, despite everything, despite the energy shock, the tariff pass-through, the Fed sitting on the hands, it still broadly believes inflation is coming back to target eventually, which is why I spoke about the fact that, inflation expectations and terminal rate are probably anchored in these further out contracts, because the market is not seeing this as a massive structural change in inflation. It's just not. But this is the critical bit. Near-term inflation swaps have moved. The short end of the inflation swap curve has repriced, and that pattern, the long end and the long end anchored with the short end moving, tells you something very specific about how the market is positioned. So the market obviously believes, at the current state, it believes in the transitory story, but it's definitely actively hedging against the risk that, that whole transitory story is wrong. And that is a credibility crisis, but we're just not there yet. Now, the question you should be asking is, what would cause that 5 to 10 year range to break? What would cause people to start saying, I expect us to have much higher inflation in these years? What would cause that? Well, the answer is wages. That is one input, and that is a massive input. If wage growth starts running hot in any type of sustained way, unit labor costs, average hourly earnings, then that's the mechanism through which a supply side price shock kind of stops being this whole transitory story, and it becomes embedded in the economy's cost structure. Once workers start demanding higher wages, and I spoke about that through here. Basically this, look, once workers start, demanding higher wages to compensate for higher prices, and companies pass those costs onto their pricing, and the consumer is expecting higher prices and pulling forward their purchases, the process just becomes self-reinforcing. It's just a feedback loop. Once it gets going, because I don't want to say it is going, because it's definitely not. Once it gets going, it's very hard to stop without aggressive policy action, which is when you can start seeing massive shifts in SOFR, massive changes in the terminal rate, and you always want to be monitoring. One, where is the terminal rate sitting? But two, where are we fully pricing a cut? So you see we're almost fully pricing a cut in the C7 contract. So I'd say, look at this. We're not seeing structural inflation changes in the long term. Not at all. So focus on wages as, the indicator for longer term inflation. Because if wages stay contained, then the Fed's call is probably right and the anchor holds. They're probably right that inflation is transitory, and, there's a whole story about the Fed being able to cut works. But if wages start running hot, then the whole thesis falls apart. And I actually spoke about earlier, what data matters right now. You need to ask this question because at any given time, different data matters, and you don't want to run models that have specific weightings in every regime because it just won't work. So it brings me to something I want to push back on a little, because I think there's really widespread misconception about what data matters in this type of regime. Most people, and I get it because this is what dominates financial media, are going to spend the next several months absolutely glued to every CPI print, every PCE release, and look, I'm not saying to ignore those numbers because they do matter, but in the specific regime we're in right now, where the Fed has already signaled that it's going to look through near-term inflation, or at least they've done this implicitly, then CPI and PCE are actually lagging indicators. By the time they're telling you something has gone seriously wrong, it's already embedded into the system and you've already missed out on most of the move. And I also mentioned the fact that the 2-10 curves prices this whole dynamic in real time. So it already is pricing, what's going to happen with CPI, what's going to happen with PCE. And when you look at how markets trade through these events, they're really just clearing events. It's just a catalyst. It's very, very rare, unless we're in a 2022 type economy where we get massive shocks to data prints that the market, it just catches the market off sides. You want to focus on, just to keep it simple, just focus on the 2-10 curve and what it is pricing, because it is pricing all of these changes in inflation, in growth. It is pricing credit risk, duration risk, all in real time. Now, the leading indicators in this environment are different. So first, inflation swaps across the curve, and specifically, I would say watch whether those 5 to 10 year swaps are starting to move. That's your early warning sign for credibility concerns, and it will move way before the official CPI data confirms anything, because the market, as I said earlier, is pricing things in real time. The second is unit labor costs and average hourly earnings, for the reasons I just explained. Those are early warning signs in a system for second round effects. And the third is, consumer expectation surveys. Me personally, I don't put too much emphasis on this, but it doesn't mean to say that we just brush them under the carpet. So inflation expectations is what will anchor kind of where the Fed will go versus where they should go, and the market price is the gap between them. So when households obviously start expecting higher prices, everything changes, their behavior changes, and the changed behavior drives the second round effects in a way that the market-based measures don't fully capture. And once again, CPI does matter, PCE does matter, but treat them as confirmation rather than your primary signal. So the market moves on leading indicators first and the official data second. If you're waiting for CPI to tell you something is wrong, then you're already too late. And this is where risks begun to build in the system at these lows in equities. We've begun to see massive shifts in the volatility complex, and that is where I'm going to focus on right now. So this is the last big section of part one, like I say, the volatility complex, and this is where I tie everything together, because I think understanding how volatility transmits across assets in cross-asset markets and how they interact with each other is genuinely key to understanding why markets have been behaving the way they have this year, or this month, or this week. A lot of the price action that seems random or confusing starts, confusing parts of markets, or, people say this doesn't make sense. All of these random or confusing things start making complete sense once you understand the volatility complex and how it transmits, because how it transmits is most important, because you may be able to understand the volatility complex, but if you don't understand how it transmits, then you're never going to be able to monetize the idea. Now, the foundational principle, and I'll say this as clearly as I can, is that rates vol, which is volatility in the 2-year, the 5-year, 10-year rates, not the bond, the rates, is kind of the parent asset class for all other volatility. So if you go back to the start, you'll see how I said that interest rates drive everything. NFX and equities are kind of the reflection of what is going on in rates and FX. So when there is genuinely, sorry, let me just slow down. When there is genuine uncertainty about where interest rates are going, that uncertainty doesn't stay contained in the bond market. So you won't just see it reflected in the bond market. It spreads into FX, then into equities. Once again, check the dynamic breakdown at the start. It's a flow chart and it feeds through. So whatever happens in the rates bonds market feeds to FX and feeds into equities. And it spreads through a very specific mechanism, and I want to walk you through that. So when rates vol starts going up and implied volatility in the bond market is elevated, the cost of hedging interest rate exposure goes up. Now that sounds abstract, or it sounds just too maybe difficult. So let me make it kind of concrete. Think about what it means for different participants in the market. So, for a corporate treasurer running a company with significant debt, their cost to hedge that debt goes up as this bond volatility goes up. For a bank running duration on its balance sheet, it becomes more expensive and more risky. So also, even think about systematic quant funds. Many of them use volatility as a direct input to their positioning sizing models. When this volatility then goes up, their models mechanically tell them to reduce exposures, so they sell. And when you have all of these things happening simultaneously under the surface as well, because it's not obvious on kind of first looks, you have corporates hedging less, banks pulling back, quant funds reducing size. There's even things I'm missing out here, but there's a massive simultaneous movements underneath the surface, and what you get is lower equilibrium prices for risk assets across the board. Not because the fundamentals have changed, but because the cost of running exposure has actually gone up. And this is why, I spoke about it before, this is why we actually see the S&P has held up much better than you might have expected, given everything going on with macro right now. The fundamental picture isn't actually bad. Earnings have been okay. The labour market isn't collapsing. Consumer spending is holding up. The drag has been the macro volatility overhead. The uncertainty about rates, which has been suppressing what valuations would otherwise be. When you remove that uncertainty, and you begin to get a rollover in pricing, volatility, uncertainty removed, you begin to have normalization in markets. So you get re-rating, once again in the forward curve, and things become more normalized. Very much what we see last April, when volatility drops, the market begins to normalize. Now, the transmission from rates vol into FX vol is really direct. So think about it from a first principles. When you don't know where the US rates are going, like when there's genuinely uncertainty about that rate path, you don't know what the carry differentials between the dollar and every other major currency is going to be. And carry differentials are massive drivers in currency positioning. And if you don't know what it's going to be, you don't know where Euro USD or USD JPY is going. So FX options become much, much more expensive. Much more expensive. And more expensive FX options, means it costs more to run open cross-border positions. So at the margin, capital flows get deterred. Like, that is as simple as people don't want to run that risk. And you get exactly the kind of choppy, two-way, non-directional price action in most currency pairs that you've been seeing in the beginning of the year. So if we just take a look at the euro dollar, you begin to have this play out, this choppy price action, which begun directly at the start of the whole Iran conflict. So, as I say, FX vol, right, it then feeds into equity vol through earnings and uncertainty, because, I think about what currency moves do to multinationals. So a big unexpected move in the euro dollar. So we've seen loads of those here, and we're beginning to see one here. A big unexpected move in the euro USD in a quarter can swing earnings per share by literally hundreds of basis points for large cap exporters, So if you're a company with 40% revenues in Europe and the euro moves 5% against you in a quarter, which last year, we were seeing massive movements. We're probably seeing much more of that this year. Significant movements. We're probably seeing much more of that this year. These are tail risks that are going to be directly transmitted into these equities. And that whole uncertainty gets priced into equity implied vol. So just implied volatility of the S&P, because equity markets are pricing the uncertainty about future cash flows. And if currency moves, create uncertainty about those cash flows, then implied vol just has to go up. It's a direct transmission. And then elevated implied vol then suppresses those valuations through both the discount rate channel and the risk premium channel at the same time. So the full channel is, once again, I'm just going to go back to here. The full channel is rates to FX to equities. It's every single time. Equities are downstream of everything else. If you keep that mental model, and I genuinely think this is the most useful single framework for understanding cross-asset behavior, a huge amount of what happened this year, what's going to happen, starts making sense. So that's all for part one. And look, as I did at the bottom, let me just do a summary. I'll have this up as I speak through it. So I'll do a quick summary of key things I want you to take away before we wrap this up. So first, the Fed is almost certainly going to look for inflation, in my view. Yes, I could be wrong. I don't think it's because, they don't see this inflation, because I definitely think they do and they understand, and they're running some crazy models on this. But I think it's more so because the labour market and consumer spending simply can't absorb hikes into a supply side price shock. I just don't think they can. And I think the Fed are going to continue to call it transitory and sit on their hands. Second thing I want you to take from here and from this whole breakdown is the front end of rates curve, so the 2-year rates, is basically trapped in a range. I think we will drift lower, but the interest in action, right, is in the long end. So what I'm watching for is bear steepening in the curve. I mean, steepening in general in the curve. So we see a whole lot more of this, which we have been seeing across the last few weeks. So that's the scenario where the long end sells off. So the long end bond, 10-year rates go up, even as the front end is anchored. And that's the most hostile range, I would say, for equity valuations. And it's not priced in by most, say, models or funds right now. You just know this is not getting priced in right now. Third, I would say, as I spoke about the whole data thing here, stop watching CPI as your primary signal. Instead, start to anchor, and watch inflation swaps, especially the 5 and 10-year part of the curve, to see if we're seeing structural changes, which we're not right now, and watch wages, watch unit labor costs, average hourly earnings, because those are your real early warning, I'd say, systems for, whether this inflationary impulse is going to be genuinely transitory or whether it starts to embed. And then fourth and final, I'll just say, spend a lot of time thinking and building models and understanding the volatility transmission chain. So rates vol drives FX vol, which drives equity vol. It is as simple as that. And I'll keep this visual here. Rates vol drives FX vol, and equities show or represent the current situation inside rates and FX. That's the mechanism behind most of what you've been seeing in the markets this year. And understanding this transmission here will help a lot of the noise become signal. So part 2 is going to be a deep dive on the FX and equities section specifically, and I'm going to get into sectors, which, I'll be going over sectors that I think are most actionable part of this whole thesis. And there's some really interesting relative value ideas that will come out of this framework, right? So when you apply it sector by sector, and I want to walk through that in detail, there will be opportunities, no doubt. So make sure you're, subscribed. You'll get notified when the next one drops. For anyone who wants to dig into the full report, this is the most recent report, part 1. What if the Fed looked for inflation? And yeah, let me know what you guys think, and I will see you in part 2.